actually, I did own some of the Asian stocks. I had some tech stocks in Asia. Some of them are in our funds. So we caught a bit of the tech rally, but we're way underweight tech in general. But where we're able to participate was in the gold stocks, because the gold stocks had a decent quarter, not a spectacular quarter, but they had a decent quarter. The GDX was up 13% on the quarter. And the juniors actually didn't even do as well. They were up about 10% on the quarter. Now, for those of you who are shareholders of the Euro Pacific Gold Fund, we actually did a little bit better during the quarter than both of those index. The Euro Pacific Gold Fund was up 14.2% during the first quarter. So not nearly as much as the NASDAQ, although actually not that far behind, 17% versus 14%. So almost as good as the NASDAQ, but a lot better than the S&P, and certainly even more better than the Russell 2000 or the Dow. And what I think should be going on right now is more people who are buying these tech stocks should actually be buying gold stocks instead, because I think the gold stocks are the new tech stocks for this new easing cycle. The people who are buying tech stocks all quarter were correct in their judgment that we were coming to the end of the tightening cycle, because we were. And they were correct to anticipate that there would be an easing, which there already has been. I mean, the Fed has already acknowledged that it's probably not going to hike much, if at all. And whether they want to admit it or not, they're back to quantitative easing. Although this week on Thursday, when they reported the balance sheet, it actually shrank again by about 25 billion. So we didn't have a third week in a row of an expansion. There was a little bit of a contraction, but I think that is the exception, not the rule. I think going forward, we're going to see the balance sheet continue to expand. Every once in a while, there may be a weekly contraction, but the direction now for the balance sheet is up. But I think investors are wrong in thinking that this easing cycle is going to be good for tech stocks. I think they've got it wrong. The last easing cycle was great for tech stocks, but I don't think that we're going to repeat that. I think this time around, it's going to be gold stocks. And in fact, if you go back to the 2000 bubble that popped, and NASDAQ was down 80%, mostly because of those tech stocks, the tech stocks rebounded from 2002 to 2008 when we had the financial crisis. But the gold stocks did much better during that easing cycle, because the Fed moved rates down to 1% and then kept them there for a while and then gradually normalized. But during that entire cycle, the gold stocks actually did much better than the tech stocks. So I think the same thing is going to happen this time. It's not going to be the people in tech stocks are going to make money again like they did from 2000 and 9-ish all the way through 2021 or whenever that bubble finally peaked. It's not going to be the same, nor is it going to be the crazy days of the COVID lockdowns where all these tech stocks, went ballistic. Because what I think investors don't get is that inflation is the wild card, because it's not going back down. The last easing cycle was good for tech stocks because inflation was below 2%, at least the inflation that anybody admitted to, right? The Fed was below 2%. And so in that environment, it was able to get away with quantitative easing, low interest rates, and the dollar was strong during that time period. And so I think this favored the tech stocks. But I don't think this easing cycle is going to look anything like that, because what I think is going to happen this time is inflation is already well above 2%. And, we got some more inflation data on Friday. We got the personal consumption expenditure index, and contained within that number, there was a better than expected reading on inflation, but just barely. The core PCE, which is the least accurate and therefore the Fed's favorite way to measure inflation because it understates it the most, it was supposed to go up by 0.4 on the month, and it went up by 0.3. I mean, big deal, because 0.3 annualized is still way above the Fed's 2% level. I think it's right now, if it annualizes out, I think year over year, we're at 4.6% rise in the core PCE. The core, right? That strips out food and energy, right? Which was even higher. But even if you strip that stuff out and you go down to the core, you're still at 4.6% year over year. Yes, that was slightly better than the 4.7% that they were looking for, but it's nowhere near the 2%. But what's more significant about that is that that's where the year over year core PCE is when the Fed has stopped the inflation fight. It is no longer hiking rates, but more importantly than the rate hikes, it's back to quantitative easing. The Fed is creating inflation. The Fed is printing money all over again, and that just fuels the inflation fire. So I think we're kind of at trough inflation now. Maybe it gets a little bit lower, but we're not going to get anywhere near 2, and then we're just going to pick up momentum and head for new highs. And that is going to create a completely different environment for tech stocks and for gold stocks. But now it's going to be the reverse. We're going to have a weakening dollar. It's going to be like 2002 to 2008. During that time frame, the dollar went way down. The dollar index went from 120 down to 70. That's when gold went from 300 to 1,000. That's when gold stocks did much better than tech stocks. That's the environment that I think we're in, except on a bigger scale, because the U.S. is starting this cycle in much worse financial shape than it was in 2000. We had a much bigger bubble. The Fed has a much bigger balance sheet. There's been much more damage done to the underlying structure of the economy. And so now I think the moves in the dollar, in gold, are going to be much bigger. And the other main difference is going to be the end game, because paradoxically, the dollar's decline and gold's rally came to an end in 2008 with the financial crisis. And that paradoxically caused the oversold dollar to bounce. And it caused investors to take profits in gold. This time, I don't think that's going to happen, because this crisis is going to be punctuated by a dollar crisis, by a sovereign debt crisis. And when that happens, nobody is going to take refuge in the dollar when they're trying to get out of the dollar. And no one is going to take refuge in U.S. treasuries if they want to get out of the dollar, because U.S. treasuries are denominated in dollars. So a dollar crisis will look much different than a financial crisis, and the impact will be far different in the financial markets, in the foreign exchange, and precious metals. And all this, I think, is happening. I think it's going to be happening at an accelerated pace. So a lot of people, they did okay in Q1. They made some money in these tech stocks. They made money even in bonds, rallied a bit. But don't be lulled into a false sense of security. If you stay on that path, you are not going to make money. In fact, you could lose a tremendous amount of money. What's even worse, it's not just losing money, it's losing purchasing power. Because even if you don't lose your money is going to lose its purchasing power. So what you got to do is, again, read between the lines and the writing on the wall and change your portfolio. Foreign stocks, again, beat the U.S. stock market. They didn't beat the NASDAQ, but, they beat the Dow, beat the S&P. So the foreign markets are already doing better, but I think that they'll do even better in the later quarters of the year, particularly in the back half of the year relative to the U.S. market, when the dollar really starts to fall, and that gives a big tailwind to the non-dollar portfolio, and in particular, the gold and precious metals.